Here's what you don't know about how the wealthy transfer money to their kids without paying estate tax. Now, a lot of people think gifting is like writing a check for $17,000, but the wealthy, they use a lot of these special tools that let them transfer sometimes millions of dollars tax-free while keeping control of the money. So let's break down one of their favorites right here. Okay, and that favorite is the GRAT, the Grantor Retained Annuity Trust. And what that really is it's a way to shift growth out of your estate without using your lifetime exemption, and you still get your money back. Now, what is your lifetime exemption, you may ask? It's basically a coupon the IRS gives you that lets you transfer that amount either during your lifetime or at death without paying estate tax on. And right now, that number is pretty big. It's over 13 million each per person, double that per a couple. If you're over that amount, so if you gift over that amount either during your life or at death, you will pay estate tax, and that estate tax is at 40%. Now that seems like a high number, I'm mentioning it now, but in the end of this year, this is going down to about 6 or 7 million if no rules are changed. All right, let me give an example of going back to my main man, Frank. Let's say my main man, Frank, he's done well in his life. He wants to gift $1 million. So this is Frank. He's what we call the grantor. He wants to gift $1 million into a GRAT. What happens is that he chooses the term, either like 2 to 10 years. Well, he will get a return of his principal. He'll actually get the $1 million back. Now, what happens, if I can write, is that let's say his $1 million grew to $1.6 million. This $600,000 will go to his beneficiaries if it does better than what's called the hurdle rate. It's an IRS kind of interest rate, if you will, that essentially the GRAT just has to beat for that to go to the beneficiaries tax-free of estate tax. Now, GRATs are not for everyone. It's definitely for people who have a little bit more net worth, but what do you put into there? What type of assets? And essentially you want to put assets that have a lot of growth potential. Stocks, business interests, IPO type of stuff. And why you're doing this is essentially it's getting growth or future growth of somebody's estate out of their estate without paying any taxes on it, and they get to still keep control. Taxes, estate, control. Now, if you have a fast-growing estate, a large estate, or if you want to talk about this further, feel free to give me a call and we'll talk about it more. Thanks.